Our next guest says second quarter earnings overall underscore the health of the economy is adding fuel to the narrative that we are in the midst of a soft landing. Marta Norton is Chief Investment Officer for the Americas at Morningstar Wealth. Marta, great to have you with us. I first want to ask you what your opinion is on what we're seeing so far today. We saw the PPI numbers come in hotter than expected, most of that driven by an increase in the cost of portfolio management. We saw yields on the 10-year pop higher, and we're seeing the NASDAQ under pressure the most. It's now down 100 points pre-market, which is still less than a percent decline, but it does seem to be worsening as we get closer to the opening bell. What's your take on all of this?
Right. So, of course, the PPI is not necessarily confirming, at least as strongly as folks would like, what we saw with the CPI yesterday and what we saw with the CPI in June. So clearly, the market is trying to digest what the inflation picture is. But despite today's report, I think the broad strokes of the inflation movement is toward disinflation, which would suggest that this fight is at least nearing the later innings. So I think that while this report isn't maybe what the market wants to see, I don't know if it really upends the disinflation narrative.
What's your take on sort of the higher multiple areas of the market? Because what we are seeing very clearly, and we've seen this in past sessions, but in particular this morning as well, 10-year goes above 4.1%, and we've got real pressure on some of the higher multiple areas of the market, like semiconductors, which right now down 1.2% as measured by the SMH, the semi ETF. We've got Tesla down 1.2%, NVIDIA, of course, a high flyer of 1.3% roughly.
Right. So when we're taking a look at the market overall, I mean, as we all know, the market is a forward-looking mechanism. And so the inflation party, or the goodbye inflation party that started maybe in the fourth quarter of last year and has continued through the bulk of this year, really benefited those higher multiple stocks. And so those companies are really at nosebleed valuations. And I think it takes any small disappointment to upend the kind of party that they've been having. And so as we're taking a look at the market today, we're thinking more about rotation, moving away from some of these higher multiple areas of the market and looking towards some of these areas that haven't participated quite as much. So that brings materials to mind, it brings banks to mind, it brings some areas of communication services which we think are a little bit better valued.
Some areas like an AT&T, for instance? I mean, I'm not sure if you can talk individual stocks. When you say other areas of communication service, I'm just wondering what you mean by that.
Yep. So you're right. Communication services is a very broad sector. It's home to Meta, it's home to Alphabet, it's home to Disney and Netflix. But then you're right, it's also home to some of these cable companies. And so it's kind of a tale of a bunch of different types of markets. We really look across that whole breadth and think all of them are attractively valued. Meta, of course, suffered a terrible rout last year. It's had a great run this year, but that pullback that it saw last year gave us a little bit more breathing room to see some of the expansion that we saw this year. Same with Alphabet. So we're looking both at those cable companies, which look attractively valued to us, and some of the higher multiple stocks that are in that area.
For the financials as part of that, or as a big part of that, because we've seen them perk up recently because of the steepening of the curve. You call it a bear, you could call it whatever you want, bear steepening, whatever it is, but it is steepening, and that should help, in theory, financials.
So with financials, of course, they suffered this tremendous sell-off, and we are seeing some kind of rally back in recent weeks and recent months within the banks in particular. And I think they are kind of benefiting from this focus on a soft landing. They are benefiting from the focus that potentially interest rates aren't going to march ever higher. But there's still concerns around banks. And that's why when we're entering that type of market, we're doing it at really kind of piecemeal steps, or just kind of slowly edging in. Because as we think about things like commercial real estate, as we think about the uncertainty that still exists around the inflation and rate narrative, we want to make sure we have room to add should we see continued sell-off.
You point out the discrepancy in valuations between U.S. and non-U.S., and I'm specifically wondering what non-U.S. areas you're looking at.
Well, I think that's an important question, Melissa, because it's not necessarily the whole broad non-U.S. market. I think there are segments of outside, stocks outside the U.S. that look attractive. We're looking particularly at the U.K. We're looking at Germany, European financials, and emerging markets, broadly speaking. Those are some of the areas that we're focused on outside the U.S.